So here in our last video, we are looking at our example of inventory, right? So we are a merchandising company now, and that means that we have this new asset called inventory. In the previous video, we went through the example where we were buying the inventory. So essentially, we're buying items to stock our shelves. And now we're getting to the point on November 10th where we're actually going to sell some of those goods, some of that inventory to a customer. Okay, so November 10th, we're going to sell $1,200 worth of goods to a customer for cash. Let's just stop there, right? Because this is something that we should be familiar with. Whenever we, in previous examples, provided services to a customer in exchange for cash, we always used cash and revenue in our accounting equation, right? And the same sort of thing is going to happen here, except instead of using cash and revenue, we are going to use cash and sales revenue. So sales revenue is the new account name that we introduced in the very first video that we use as our revenue account when products are sold to customers. So in our accounting equation template on November 10th, I have cash. Cash is an asset and it's increasing. I just received $1,200. Cash asset increasing by $1,200. And then I'm going to use the new account sales revenue, and sales revenue, just like the other revenues that we've used before, has its own column, the revenue column. And we want to see that increase by $1,200. So cash and sales revenue, that's the first part of our transaction. But now you'll see that there's an additional piece to our transaction. So I'm essentially breaking our transaction into two. This is the first transaction, the actual sale of the goods. And now the second piece to this transaction is the cost associated with those goods. So you'll remember in the previous lesson, in the previous video lectures, we introduced the new account name. It is an expense and it's called cost of goods sold. And we have to account for this expense anytime we sell goods to a customer. So we have the sales revenue piece, that's how much we charge the customer. But now we also have to account for the cost of the goods that we just sold. Cost of goods sold. So the second piece of this in our accounting equation template is going to be cost of goods sold. And now we have to think, okay, there has to be another piece to this to balance it out, right? If we have cost of goods sold, which is an expense, which means it's always going to be a negative amount, negative 400, that's the cost that was given to us in the problem, we can see our journal entry or our accounting equation doesn't balance, right? We have $1,200 on the asset side and we have $800 on the liability and equity side. So we have to think, okay, what's going to be the thing that's going to make this balance out, right? And if you think about what happened in the November 10th transaction, we had inventory on our shelves and we then just sold it to a customer. So do we have that inventory anymore? Absolutely not. Inventory, which is an asset, is also decreasing by 400, okay? So in every one of these sale transactions, what you have to remember is that there's going to be a sale piece and there's going to be a cost of inventory piece. The sale piece is how much did you sell those goods to the customer, period, end of story, right? The cost piece is what was the cost of those goods that you just sold? You account for that as cost of goods sold. And then you also account for that as your inventory decrease. We don't have those inventory items anymore. We just sold them to the customer. So we need to show that our inventory is decreasing by $400. So the sale piece and then the cost piece. For every one of these transactions, that's what we're going to see, the sale piece and the cost piece, okay? So November 13th, we're going to sell $1,000 worth of goods again to a customer, but this time it's on credit. On credit. Credit terms are 310, net 30. So let's just take that piece as is, right? We sell goods to a customer on credit, and we've done this one before. If we jump over into our Excel spreadsheet and we go to accounts defined, you'll remember that account receivable is the name that we use for an amount that is owed to us from our customer. So we're going to sell them their goods, right? We're going to give them their goods, but we are going to receive the cash from them at a later date. We don't get cash today. So instead, we're going to use account receivable. So we're first going to use account receivable. We just learned again, or reminded ourselves, that account receivable is an asset and it's increasing. They owe us $1,000, right? That's how much cash we're supposed to get in the future. And then the other piece, sales revenue. Sales revenue has its own column under revenue, again, $1,000. So we're going to get to the credit terms here in a second, right? Again, we were given credit terms, just like we were given credit terms when we bought. Now we're telling our customer that these are your credit terms. We're going to get to that in a second. But let's talk about, that was the first piece, the sale piece. Now we need to get to number two, the cost piece. So the cost of the goods that we just sold, cost of goods sold, which is an expense, is a negative 300, because expenses always decrease equity. They're always negative. And then we also want to again see that that inventory that we had, we no longer have. We just sold it to the customer. So inventory, which is an asset, is also decreasing by 300, right? And so again, two pieces to every one of these sale transaction. There's the sale piece and there's the cost piece. On November 13th, there's the sale piece and there's the cost piece, right? So very similar, November 10th and November 13th. The only difference is that we didn't get cash right away. Okay, so now we have to think about those credit terms, 3, 10, and 30, right? What we learned in the previous video about those credit terms is that the first piece of it is giving our customer what their discount would be. If they pay within 10 days, they will receive a 3% discount. Okay, so 3% discount if you pay within 10 days. You get no discount and you have to pay within 30 days, the full amount, right? So if you don't take advantage of that discounted amount, then you actually have to pay the full amount in 30 days. So these are now credit terms that we're giving. We're giving our customer the opportunity to get a discount on what they're buying from us, right? A little bit different than what we talked about before, where we were getting the discount. Now we're giving the discount, okay? So we have to think about what that's going to mean when it comes to receiving payment from that customer. So here we go. November 19th, we're going to receive payment from that customer. They owe us $1,000, right? So the first thing that we have to ask ourselves is, of that $1,000, are we going to give them the discount? Are they paying us within the discount period, right? If the discount period was 10 days, they are within that discount period. And that means that they're going to get $1,000 times 3%. They are going to get a $30 sales discount, okay? If they're getting a $30 sales discount, but they owed us $1,000, what we have to understand is that the amount of cash that we're actually going to get is only going to be $970, right? We give them that $30 discount. That means that we're not going to get those $30 in cash. Okay. So we have all of the pieces of information that we need in order to analyze this last transaction, November 19th. We're again going to use 3 lines, because what we have to understand is, number one, the account receivable should go down by the full amount, $1,000. They are paying us what they owe us. So this $1,000 of account receivable that we established on November 13th, we want it to go down to 0 now on November 19th. They are paying us what they owe. But we also know that the amount of cash that we're going to receive based on that discount is only, cash is an asset, is only $970. That's the amount of cash that we received. So we see that our accounting equation doesn't balance, right? There's that additional $30 that we have to account for somewhere. If you go over to the accounts defined, you'll see, again, one of the new account names that we're going to use, sales discounts. When products are sold to customers, but the customer is given a discount on the price. And we know that that's going to fall under the same column as the sales revenue does, but it's going to be contra to that revenue. When you hear contra, you have to think opposite of. So in our accounting equation template, sales discount is going to fall under our revenue column, but it's going to be negative, right? We want to show that, yes, they earned $1,000 of revenue, but we also gave the customer a $30 discount. So $1,000 of sales revenue minus the discount of $30 leaves us with $970 of net revenues. So sales discount is going to fall under that revenue column, and it's going to be a negative amount. It's basically offsetting, a little bit offsetting the amount of revenue that we've earned. And you can see finally that our accounting equation still holds true. Our assets do equal our liabilities and equity after all is said and done. So what we went through in our lecture here about a merchandising company is sort of understanding how they are different from a service organization. We introduced a few new account names, and then we were able to analyze both the buying of inventory and the selling of inventory in accordance with our accounting equation. So there's going to be a homework problem that looks very similar to the one that we did here together in our lecture that you'll be expected to do in order to be able to account for the transactions of inventory of a merchandising company.